After that fascinating discussion, it's now, of course, time to turn to our Amundi experts for their insights and views on what we've just heard. With me on stage, Amundi Group Chief Investment Officer, Vincent Mortier.
Hello.
Welcome to you. And also Monica Defend, Head of the Amundi Institute. Pleasure to have you with us.
Thank you.
Monica, I'm going to start with you. We've just heard a lot about how India and China are transforming their economic models into powerful global engines. We saw the numbers. What opportunities for investors does this rebalance of power towards Asian giants bring?
Yeah, sure. Well, we see at least three opportunities. The first one, portfolio diversification. India and China entered a strategic economic transition, but they are at different stages of it. India and China have very significant geopolitical power. This makes them strategic allies. The Chinese and Indian equity markets show low correlation to each other and to major global indexes, while the inflation and debt dynamic differ substantially. The second opportunity lies in sector-specific prospects. Think about India. We heard about it. It has the potential to invest in manufacturing, diversification of supply chain, while China, on the other hand, has growth opportunity in the service sector and consumer sector. Both of them are technological giants. Think about semiconductors. And also in the energy transition, they can really play a big role in the production of batteries, solar panels. The third opportunity, green bond market. Green bond market is vital to finance the energy transition. There is a strong appetite from investors on this asset class, but supply is quite limited. India and China are big issuers of these green bonds. So in asset allocation, this is really encouraging us to allocate part of our portfolio into Chinese and Indian assets to get higher growth, potential higher expected return, but be aware that you can see potentially some volatility on investment flows just because this is sensitive to geopolitical news, for example, or to some liquidity constraint in some certain promising segments.
Understood. Very clearly spelled out there. Beyond China, though, and India, what themes should investors consider in their portfolio in the midterm?
Yeah, indeed. I see four significant trends. First one, and you mentioned it, a shift of growth and wealth from west to east. So, of course, China and India, you mentioned it, but as well other countries in the region, like Indonesia or Vietnam, on the back of supply chain diversification. Second trend to consider, the strategic autonomy and energy transition agenda, which are very important. It will bring more growth at target, but as well more inflation and much more financing needs. And all this will have, of course, impact on the various markets that investors need to consider. Third impact, demographics. In some countries will be a key challenge with an aging population and a declining workforce. Of course, the magical artificial intelligence can help a little bit, but nevertheless, we should be aware about the inequalities that could be triggered by it between the haves and the have-nots. And last trend, some companies will face increased pressures on their business model and on their balance sheet due to a higher cost of debt and some declining revenues or pressure on margins. And therefore, more than ever, we think focus should be put on quality.
Quality. Monica, we've heard about the complexity of the new economic cycle and some of the trends to look out for, but higher fragmentation in the geopolitical landscape, what elements should investors think about and consider at this critical juncture right now? Where will the pieces fall?
I wish I had a crystal ball. Let me provide you some context before and add three elements. We are seeing a tricky combination of low growth and stubborn and sticky inflation. We are living a new global disorder. President Draghi was calling supranational challenges. What is happening is that we entered multiple transitions all at the same time. Think about trade. I like to address this as the transformative globalization, just to group shoring, offshoring, friendshoring, all these new alliances that are going to forge trade patterns and therefore economic dynamics. Second, the era of abundance, liquidity abundance from the central banks is coming to an end. While third, and we heard already about this morning, debt overhang. This is really creating some constraint on the fiscal space, on budgets when economies enters downturns. And we will really need, as we said, monetary policy and fiscal policy to work together. But now, what does it mean for investors? We think that it is time for investors to embrace a dynamic asset allocation, just because expected return on asset class are going to be more volatile, less predictable, and investors should be agile in nesting short tactical positioning into more medium-term market regimes. So currently this means basically that we are positioning on a cautious stance because we fear that earnings, corporate earnings, are going to cool down further, and this will initiate a correction in the financial market, and we favor bonds. Apart from what the Bank of England did today, we think that central banks are really approaching the peak of their their tightening cycle. So what's next? Probably the next market regime will come into place as soon as earnings, economic growth will downturn up again. And this hopefully, finger crossed, might take place by the end of the year.
Thank you very much, Monica. You're looking forward, but I'm going to just look back for a moment with you, Vincent, because this year we've seen conflicting narratives emerge. Soft landing versus recession, deep banking crisis versus no crisis in banks, rate cuts versus further rate hikes. I can continue, but against this backdrop, what is your main advice for investors?
Well, beware of a growing disconnect that we see between some market prices and what we can assess as a fair value risk-adjusted. So for us, it is linked to three psychological behavior I will comment, which has been very at play during the first half. First one is a tendency of some investors to of following the trend and following fashion in order to look good, to have beautiful portfolios to show to their clients. So this is tempting, but sometimes it is done whatever the valuation levels, which can be a dangerous game long term. Second behavior, the famous fear of missing out, which is linked to the first one. So a tendency to follow the trend, and which usually in history has led to some bubbles. And reality always catches up, and markets then readjust. The third behavior, more and more investors are forgetting about liquidity and about market liquidity. Well, don't always the prices you see on the screen. In case of market stress or in certain circumstances, you can get prices which are a little bit different or very different, 10-20% discount. It happened in the last years or months. So it's all the more important that investors have allocated more money to less liquid assets in the recent past. So to summarize, what we take out, we think that this market disconnect, if you may say, will last for quite some time. It's not an issue for long-term investors because they are here for the long-term return. Short term, of course, you may have some underperformances, but that's normal. Don't be alarmed by it. It may happen. And therefore, we recommend assessing each opportunity based on the risk-reward at the time horizon of the investment. And therefore, two things: do not compromise on discipline, and do not chase each and every rally.
Very wise words to wrap up our final panel here at the Amundi World Investment Forum. Thank you very much, Monica Defend and Vincent Mortier. A round of applause for our panel.